no matter which way I talk around it, I keep coming back to the same thing, which is they're playing with their food until they do industrial policy, yield curve control, capital controls, devalue the dollar, devalue the debt to GDP, and reset the system to something where the dollar is still the reserve currency, but gold is the neutral reserve asset. Then we can compete. Otherwise, we're just, it's just like, okay, here we go again. I might as well just go to the beach for the next 3 months because this, what are they doing?
So let's dig into the situation in the bond market and the fiscal path. And just to contextualize it a little bit here is, based on some napkin math that I've seen so far, based on where the effective tariff rate is at this juncture with this new trade deal, it's around 12.5%. So 12.5% effective tariff rate. We're running a 7% of GDP fiscal deficit. And then now you have what's coming forth in terms of these major tax cuts that are coming down the pike. When you start to balance all of these together, and also Doge, which was originally saying about 2 trillion in cuts, we're now down to about 150 billion. It's basically, that's just a couple days worth of interest expense, right? So when you put that all together, what's your outlook for the fiscal path from here on out, and how does that get intersected with the bond market here?
I have not rerun the math with the tariffs where they are. I just looked at, I think they did, I don't know, like 30 billion in a month or something like last month. And I don't know sort of what that represented relative to sort of where we were and where we are. I've seen 500 or 600 billion a year in interest, or excuse me, in tariffs, maybe even 700 billion. And as best case scenarios prior to where we are today. And if you look at what the US collects from its bottom 90% of taxpayers on the individual side, it's like 675 billion. And so in sort of a perfect, vacuum, in theory, a lot of what we were collecting on tariffs before that moved could offset Trump basically cutting income taxes to zero for like the bottom 90% of individual taxpayers. That assumes no other offsets, et cetera. And then I don't, that is also tax cut agnostic. I don't, I've not sort of run that math. That would be very stimulative, and so that's where it starts to get some of the reflexivities of that. Okay, if that's stimulative, then the economy grows faster. 10-year yields probably go up. 10-year yields go up. Like, does that restrict the economy? Does that drive a higher interest expense? So now the deficit's bigger. And it's very difficult once you get to sort of the second and third derivatives of what it could be. But just on a strictly in a vacuum basis, the tariffs, could help. It could be a huge political tool. I don't think anybody in the bottom 90% is gonna dislike, having their taxes cut significantly, maybe to zero, conceivably. Bigger picture, the deficit's, it's like you're spending. We highlighted for clients last week, we hear over and over, we're in this new Cold War, right? China, Russia. Great. Okay. Interest expense is already above, on a net basis, above defense. For the prior 85 years of U.S. history, that had never been the case. In fact, during the hottest part of the Cold War, during the Cold War, defense was never less than 4% of GDP. It's 2% today. Sorry, it's not 2%. It's actually more like 27. So it's closer to 4 today. Sorry, it's closer to 4 today. It was never less than 5 to 10 as a percent of GDP historically. And you go, all right, well, if we're in a new Cold War, the defense is going to be 6-8% of GDP. So the 7% deficit we're running today is going to have to go up another 200 to 300 basis points. So you're 9 to 10%. And that assumes, interest, they're still repricing some of your interest. Entitlements are running at 70% of receipts. Receipts are running at all-time highs. Receipts are dependent on stocks going up. Stocks need to go up 10, 15, 20% a year just to basically make the fiscal math work and to drive enough receipts. So when I put it all together, I think the deficits are going higher, and I think the market's going higher because ultimately, if the market doesn't go up by 10 to 20% a year, the market being S&P 500, you're going to have deficits creating treasury market dysfunction, and then they'll come in and have to create, whatever liquidity or take whatever policy or to make sure that equities are constantly setting new records to fund the government.